special segment of Turning Hard Times into Good Times. I'm your host, Jay Taylor. Well, as you know, I like to have Michael Oliver on my radio show whenever possible. Sometimes it's not possible given other scheduled guests, but Michael was available to provide us with an update of his views on some key markets, and I'm talking to him on a pre-recorded interview here at about 5 o'clock on Labor Day, September 7th. Welcome, Michael, and thanks for joining me again.
Hi, Jay. Good to be back.
Really always good to have you, and I should mention to my listeners before we go any further so I don't forget, those that would like to check out Michael's work can go to olivermsa.com, Oliver, M as in Mary, S as in Sam, A as in Albert.com. Well, Michael, you've been advising your subscribers now for quite a while to be ready for some major changes. I remember you put out something called Major Plate Tectonic Changes. You were talking about debt and equity markets and commodity markets and the precious metals markets and the like. And you've been kind of getting your subscribers ready now over the last number of months for some major changes in these markets. And it seems to have, it just seemed to have been not much happening. But your work continued to suggest that, hey, be patient. We have some major shifts coming. And, of course, now we've seen some major moves in the equity markets. But, of course, every time I turn on CNBC or Bloomberg, we've always got some pretty faces up there talking about how it's really paid off for people to buy the dips, just buy the dips. And, indeed, they're right. Since 2008, 2009, if you were patient and you went in and bought the dips, you did very, very well. What are your charts and your work? What are they telling you now about the U.S. equity markets? Should we be looking for an entry point here or not?
No, I think if you're an investor, long-only investor, that is, you could be a short investor too. Reality goes both ways. But if you're a long-only investor, I think you should be gone. You should go find something else to do for the next couple of years, not just a year. Most bear markets envelop at least tag in at least 3 years. Make part of 1 year, full another year, and then part of another year. 3 years are usually involved in any bear market. I think you're headed for a bear market. Some folks argue we're headed for a disastrous bear market, and I can't deny the fundamental nature of their argument, because I do have my own fundamental view, which is
sure
a lot of these folks. But as a technician, my outlook is, while it can be long-term, it has to have some sort of fence to it, some sort of parameter. And right now I can argue, yes, we're headed for a bear market. We've triggered the numbers. We topped where I thought we should top. When we blew the final support level that I saw, support level meaning if you break it, it's a sell signal. When we hit 2041, the price of the S&P back on August 20th. And in the next 8 trading hours, the S&P dropped 174 points. So to some extent, that was like a sudden change in reality for many investors. In fact, it was a total head chopping for anybody who bought the market in the last year and a half. Gone.
Right.
In 8 trading hours.
Right.
And now they're groping around for, where's reality? Where's Waldo? Where am I on this map?
Right.
And I don't think this first leg is finished. I think we're in congestion. We may stay here for another few weeks. We may go ahead and fulfill this right away. But I suspect that the first leg down, in hindsight, of the bear market will be to under 1,700 on the S&P. That's a pretty good haircut. That takes away a good couple years of the S&P, and it does so quickly, which is often the way tops occur. If you're not quick, boom, it's gone. The last 2 years of egregiousness are wiped out in hours or days. So that's what I see there. Then ultimately I see more downside next year. But for this year, really my horizon is that probably the low of the year is below 1,700. Probably not much lower than that, and maybe then a good little rally to tease folks for a few months, but do not trust any rallies.
All right, so you're looking at something of 2.5, 3.5, 3 years or something like that down the road from here, Michael?
From here, and I view it as you take it in segments, and some of these segments are pretty big, and you don't worry about day trading or that type of analysis, but my analysis says that there'll be some big chunks here. Remember the 2000 bear market and the 2008 bear market? There were big rallies in between there.
Sure.
Hair curlers, a couple months involved quite often. So I expect the same this time, but with the huge downdrafts in there. And I think we're in that first big downdraft right now.
Well, you certainly, you've been talking for some time. This is not a big surprise to you, I think. I believe you've been telling us, warning your subscribers for some time, your structural work, your momentum work was suggesting that we were approaching something. I mean, as you pointed out on this show, we've been going along here for the better part of a year, and nothing's really happening. We see these big runs in a given day or two, big upticks in the market, and people get sort of excited about it. But in fact, as you pointed out, what are you talking about, Taylor? This is no bull market. We're not going anywhere in the last year or so. So while a lot of people were probably really shocked by this sudden move, you certainly had your subscribers prepared for it as best you could. So equity markets in general, U.S. stocks were the last ones to go down. Do you see the same thing for global equities in general, some of the other international markets that you look at?
Yes, I do. I think you need to segregate the two from the emerging markets and the developed markets. Developed being us, UK, Europe, and Japan, especially. Emerging markets, of course, being China, India, Brazil, and so forth.
Yeah.
They've been under pressure for most of the emerging markets. Really peaked in 2011. If you average them out and use the EEM, which is the ETF of the emerging markets, it peaked in 2011-ish, and and then it dropped and it went to sleep. Now it's dropping again. So it's really been down sideways and now down again. So it's been negative since 2011, and it's under a lot of pressure. A lot of people are blaming the emerging markets on the contagion effect to the developed markets. Fine, good excuse and all that.
Yeah.
I expect the emerging markets to bottom well before the developed markets do. It's now the developed markets' turn to have the stuff dished out. The emerging markets are, in my view, probably you should take them selectively, but you should be viewing them a little more positively than the developed markets. I think the roles have changed now, total role reversal. Also, I think at the same time, what goes with the emerging markets are the commodity markets. They tend to be in sync technically. Their performance trends tend to be about the same. And I'm therefore looking for bottoming-type patterns in commodities plus the relative strength of commodities relative to equities. Also looking for the same thing in the emerging markets, bottoming patterns and relative strength trend changes, where emerging markets are better places to be than developed markets. In fact, for those people who are open to the idea of pair trades or market-neutral trades, it might be quite advantageous, regardless of whether emerging markets continue down anymore, is to be long emerging markets or a basket of them, short the developed markets as a spread.
Interesting.
And I think that spread can make quite a bit of money. I think the emerging markets are essentially exhausted. There may be another 5% or so down, but the spreads are already starting to turn. This is also true with a lot of commodities, particularly gold. Gold doesn't show it on its price veneer, but its relative performance versus commodities is stellar. It's in all-time new highs. And its relative performance versus the S&P has just broken out over the last several weeks, meaning that my measurements of gold's performance versus the S&P have now shifted from having been negative since when gold peaked in 1900 and in 2011. Its performance collapsed just like its price did. Now its relative performance charts are flipping back up. Now, in part, that's due not to gold's strength, but to S&P weakness.
Sure.
But nevertheless, it is a shift in the relative performance difference between gold and the S&P. And I think that's a very important technical feature, regardless of the seeming meandering of gold itself. I think it's one of these background taps on the shoulder that says, beware, gold is turning.
All right. Do you think then that if commodities are turning and perhaps precious metals along with commodities, that that would happen in tandem then with a turn in the emerging markets, or do you think the commodities might move ahead of the emerging markets?
It's a mixed bag. Some emerging markets might turn before others. Just like in developed markets, there's some that are stronger and some that are weaker. Same is true among the emerging markets. Brazil is not India. So you have to treat them individually. But the commodities is the same story. Within the commodity space, gold is the strongest beast out there. In fact, its spread is an all-time new highs relative to the Bloomberg Commodity Index. It's higher than it is now against the basket of commodities than it was in 2011.
Yeah, that's very interesting. Michael, I actually measure it against the Rogers Fund. I do something similar to what you do, and that is true also of the Rogers Fund. Very interesting.
Statement. Yes.
Yeah. So do you think then that we could be moving? I mean, within the commodity sector, of course, you follow individual commodities. You follow oil separately. I think you also follow copper, probably. Do you?
Yeah.
So within and within those commodities, then there are certain commodities that you think might be the first ones, the earlier ones to rise. You put out something this past week on oil that was turning a little bit more constructive on oil. Suggesting that we may be nearing a bottom or in a bottoming out process. Is that? Do I have you right there on that?
I think that's a good way to phrase it. I think oil may not sustain in the upside. It has nice rallies. For instance, the recent $10 rally, which my short-term work did see coming, but it would define it as a short-term rally, and sure enough, it was. It went from under 38 to 49 in a heartbeat. But now we're back to 44, But I do think that process that we're seeing in oil now is the final drying up process of the downside, where you go up and you go down, but now you're really not going down at any hectic pace anymore. I think there's a bottoming process. I really don't foresee an upside breakout in oil, though, where you can buy it and it actually goes up for a sustained period of time until probably early next year.
Okay.
So between now and then, it could be a floundering, a fish flopping around type of situation. Other commodities they're out of sync with each other. Like the meats look like they've got more downside, but the grains look optimal for basing and for upturns. So the grains look like they're right behind gold in terms
Interesting.
of the next category to turn. And so it's a mixed picture, and you have to treat each one with its own integrity.
Well, and you do your structural analysis, your momentum analysis with each of those items, and that's what makes your service so interesting to me, is that there's always some markets that are looking more constructive than others, and some you should probably be on the short side or out of them entirely. But you cover so many different markets, Michael, that there's always something to be interested in, something to be long and something to be short in, or something to be neutral in. So that's what makes your service so interesting. Let me ask you one more question before we complete our discussion today, and that has to do with the high yield markets. You turned pretty negative on the high yield markets some time ago, and I've made a little bit of money by going short in an ETF in a high yield market. How is that looking to you now?
It looks the same as it has for the last handful of months, at least. It looks down. I don't see the kind of – I would expect in this decline to see some panic, and I haven't seen it yet.
Yeah.
Where you get like what we had in the S&P in late August, that kind of move.
Yeah.
We've had continued, persistent, and significant decline in like HYG, which is an ETF, risk corporate debt, or EMD, which is emerging market debt. So, but I expect to see something fairly dramatic to wrap this up, or at least the next part of this downside. Panicky type action, certainly deserving of it, fundamentally speaking.
Yeah.
After all, it was an area like developed market stocks that central banks policy deliberately forced investors into.
Sure.
They discouraged people from investing in low-yield debt, safe debt, encouraged them to invest in high-risk, high-yield debt.
Right.
Therefore, that's a crowded space, just like S&P and the Nikkei are.
Right.
So consequently, the unwinding of that should also be noisy and bloody. I don't see the blood yet.
Yeah. Well, that's for sure. I mean, a crowded, dangerous space, for sure, and a one-way bet. It's been a one-way bet with central banks continuing to buy and pump money into the system. But just perhaps then, what do you see? U.S. Treasuries, long-dated Treasuries, still look pretty solid at this stage, I suppose.
Their risk in being short that stuff now, looking for higher rates, is that they are a safety bet for investors who are panicked about equities. So you get this contrary movement where you get TLT going up, the ETF of
right.
U.S. government debt going up, while HYG is going down. So they're totally net opposites. So not only is the spread continuing to favor TLT, but the net price direction is opposite. I think at some point, it's probably after the first major low in the S&P, and I don't think we've seen that yet. The Treasuries will crest in terms of price and in terms of what kind of low yield they render, and then go and join the emerging market trend, meaning go down and yields go up again. But I think the only thing holding the Treasuries up right now is not their virtue in and of themselves, but it's the fact that they still provide that safety place to be
right.
equity markets are disturbed.
Right.
But I don't think that game lasts forever.
Well, I doubt that it does last forever, but how long is forever is hard to know. I mean, certainly as long as the U.S. dollar is the world's reserve currency, and it is still, as long as people have faith in it, I suppose. But that's who knows. The thing about your work, Michael, is that if anybody can sort of start to see the breaking apart of confidence, I think your momentum work a lot of times can start to show that. I mean, you don't know what the causes are, but collectively, these markets provide some truth, and I've really appreciated your work. I've really enjoyed following your work, and I just want to tell my listeners again, if they'd like to check out what you're doing, they should go to Oliver MSA, Oliver, M as in Mary, S as in Sam, A as in Albert.com. Anything else you'd like to add today, Michael, before we say goodbye?
No, I just don't trust the recent congestion in the S&P. Again, it may last for another week or two.
Mm-hmm.
I don't trust it whatsoever. Technically, it makes no sense technically from a price point of view or a momentum structural point of view where the recent low was at 1867 in the S&P if I get in the middle of nowhere. You get under 1700 and I can make an argument for stabilization and a good rally, bear market rally, but nevertheless a good rally. That is a makes sense place to go. So far we haven't gone anywhere that makes sense, therefore I do not trust the low.
Oh, well, it seems to me that what you're saying is exactly what David Stockman said from a fundamental point of view, and the headlines there was don't buy the dips, sell the rips. So, we get the rips, don't we? We get these violent upside moves, I guess short coverings a lot of times, that you're going to see in these kind of bear markets. But, boy, it does look ominous to me, too, from a fundamental point of view. But I really thank you again, Michael, for being with us. Always a pleasure. Thanks so much, and we'll look to do it again hopefully next week.